Hello. I want to welcome all of you to this first ever Fintech Frontier pitch competition. My name is Mark Wood, and I help lead the Fintech Frontier with our wonderful partners. Fintech Frontier is a collaborative effort by Western Southern Insurance Group, Fifth Third Bank, and Centrifuge to accelerate financial services innovation, to attract, retain, and grow a community of Fintech entrepreneurs in Cincinnati. We kicked this effort off back in September with the first of 4 virtual events that explored how Fintech is transforming the financial services industry and to showcase startups who are helping to lead the way. We've had nearly 500 participants thus far. Attendees have come from 25 different states, 10 different countries, and throughout the 4-part series, we've heard from leaders ranging from investors to builders to corporate strategists. Even more exciting, though, has been the response to our pitch competition. We're focusing on 2 core themes. The first is closing the gap, how we can make financial services accessible for everyone. And the second is powering the business, which is step changing the way financial firms like Western Southern or Fifth Third do business. We've received a fantastic response to these challenges. 53 applications from founders in 7 different countries, 26 different cities across the United States. And from that group, we narrowed it down to the 9 finalists who you'll be hearing from here today. And with that, we'll be awarding $60,000 in prizes to 3 of them, which is among the largest prize pools in the country. To help us select our winners, we're joined today by 3 terrific judges who will meet after the first pitch. Jesse Vorkemper, VP and Director of Business Management Operations and Digital Analytics at Fifth Third Bank, Jim Vance, Senior Vice President and Treasurer at Western Southern Financial Group, and Stacy Browning, Managing Director at CincyTech. But they are not the only ones deciding the outcome of today's competition. During the final pitch, you'll see a poll available where you can vote inside of Hopin. This poll will be open for 10 minutes, allowing you to cast a vote for your favorite startup, which will be added into our final scoring. We simply could not be more energized. We'll be hearing from entrepreneurs who are building tech that helps communities thrive, that changes the way people engage with financial services, and that shows us what the future of fintech should look like. So let's get started. You'll be hearing 5-minute pitches from each startup, followed by 4 minutes of Q&A between the judges and the founder. So sit back, enjoy the show, and remember to vote for your favorite at the end. Let's bring our first contestant on, Dedel from New Orleans.
The problem that Dedel is currently trying to solve is that it's very difficult to negotiate and settle the outstanding invoices and bad debt accounts that a business would have with its customers. There's a lack of transparency, which breaks down the trust. I have a friend, Kate, who owed $9,000 to a university. She was contacted by their collector who said, hey, we'll accept $3,000 if you settle it today. She wanted to do this. Her employer was offering to pay for her MBA, and she couldn't get her transcripts released for the applications because she owed this debt. So she was more than willing to pay it, but she asked them, she said, I need this debt in writing. And the debt collector had to say, sorry, we can't put this debt in writing, because they didn't know that she really had it, and they didn't want to write their potential collections down unnecessarily. The whole thing broke down. She ended up paying the university nothing, and she never got her MBA. Solutions out there are expensive, notoriously aggressive. They're very difficult to scale. They pretty much are not available to small businesses. If you try to do it yourself, it's very time consuming. And if you outsource it, you inject operational risk into your business. There's 30 million Americans like Kate who have at least one bad debt account. Businesses, about 93% of all companies will see a customer who can't pay an invoice this year. They pay a combined $13 billion annually in fees to third-party collectors. Most businesses don't even send their debt to collections agencies at all. When you send your debt off to collections as a business, you can expect to get about 8 cents back for every dollar if you're outsourcing collections. If you're selling your collections outright, you're selling your bad debt to somebody, you can expect to see 4 cents for every dollar. This varies dramatically by industry and age of account too. If you try to collect in-house, it varies from collecting nothing up to what your industry best practices would be. The impact of COVID on this is that it's accelerating a bad debt crisis that our country is facing. Last month, 6 million people couldn't make their rent or mortgage payments. Banks and utility companies are seeing their bad debt accounts increase as well as many other industries across the country. The solution that Dettle is providing is a software that enables companies and their customers to efficiently negotiate and settle their overdue accounts. We do this by simplifying, improving, and automating the debt negotiation process. So how does Dettle work? An organization will invite their customer to the table to settle their debt. They'll work out an agreement with our negotiation tool, and the funds will be dispersed to the organization only once the organization has sent over a settlement agreement that the customer approves. At this point, the debt is settled, both parties can celebrate, the consumer will have one less bad debt account, and the organization will have improved their margins on their accounts receivables. We have several competitive advantages, the biggest one being we are not a debt collector. This means that we are able to use PayPal, Venmo, Stripe, and other online solutions that debt collectors are banned from using per federal regulation. We're also very easy to implement and cloud-based. So you can sign up for Dettle, and 10 minutes later, you can be inviting your customers to negotiate their debt. We scale up and down. If you only have one bad debt account, you can use Dettle. Or if you have 10,000 bad debt accounts, you can still use Dettle's negotiation tool. We have a 10% transaction fee that we charge on all settled debt. We're also looking at future revenue streams of charging for more robust features that maybe not everybody will need every time. We're also looking into licensing and partnerships and a subscription model. The team is myself and my husband. He's our COO and co-founder. I have 10 years experience in corporate finance and strategy. He's an expert on business development and government relationships, and we both have startup experience. Our current traction in our pilot program is that we have seen $400,000 in bad debt sent through Dettle's negotiation platform. We have 5 pilot sites, and we are projecting 10 pilot sites by the end of the year with $1 million in bad debt invited to settle. So the ask for today is if you know of any potential pilot sites or investors and VCs in this space, we will be raising our pre-seed round soon. We would love those introductions. You can contact me at stephanie@dettle.com. Thank you.
All right. Thank you again for sticking with us through that transition. As you heard, that was Dettle. So now let's bring the stage. We'll first have our judges, Jesse, Jim, and Stacy, joining us on stage. So the co-founder and CEO of Dettle, Stephanie Hoskins. From here, we'll initiate the 4-minute Q&A. Judges, I will let you take the lead.
Stephanie, could you tell us, trying to learn, is the customer that you reach to get the ramp up the debt holder, or do you reach out to the individual?
Yeah, so usually our target market is business to business. So we're deploying Dettle at business pilot sites, and they're then inviting their customers to use Dettle to settle the debts. We are hoping eventually to have enough sites and enough to kind of hit that tipping point where we can market directly to consumer.
Hi, you might have said this, but I was just curious how you're seeing the potential size of the market and what you can capture.
Yeah, so it's very difficult to estimate the entire size of the market. So 800 billion were sent to collections last year, but most businesses don't use collections agencies at all. And it varies by industry too. So, I mean, we know that we can capture, we are capturing businesses from various industries. Each of those organizations is going to have a different estimated ARR for us. So it's really hard to estimate what the whole market is right now.
Thank you.
Because we're opening it up, I guess, beyond what it currently is.
Hey, Stephanie, when a company decides to use your platform, what are you guys doing to protect yourself against fraud?
So we, everything is done through Plaid and Stripe so that you never are entering your bank account information with Dettle anywhere. We're not saving that information anywhere. Our tech team has also built in some other cybersecurity models and overlays too to protect that user login.
What could you explain a little bit in the B2B model what your customer acquisition, how it actually goes from reach out to actually getting a customer?
Sure. So we reach out to the decision makers at the organization, which is usually somebody in the accounts receivable department that handles this bad debt. Pretty much everyone, because 30 million Americans have bad debt. 93% of businesses see it. People in accounting, they know what we're talking about right away. Most of them have seen this problem. So for those, we're able to talk to them about Dettle, and then just kind of pursue the relationship from there. We've also reached out to, for example, a professional organization of 66,000 landlords, and they're really excited to trial this with their members and allow their members to sign on for pilots. These are landlords with like 8 to 20 units, so they're very likely to see a bad debt this year, but they're not big enough to be like a huge property management company. So it's really just been a lot of discussions with kind of industry leaders, customer discussions with the pilot sites that we do sign on. We've had a lot of positive feedback, so we've been very fortunate that we haven't had to really be too aggressive.
Stephanie, are there other companies like yours out there?
So there are complete end-to-end solutions. The healthcare industry especially will see their revenue cycle departments have these like complete solutions that will give you a propensity to pay score and tell you who to call and when to call them and kind of help guide you through that. But on the other hand, 20% of healthcare organizations have zero collections at all. They don't even call somebody when a bill is overdue. So we see a niche in the market of targeting this very specific piece of the debt collections process, where it's pretty much as soon as the bill is overdue, but prior to sending it through your traditional debt collection channels. And so this is a good entry point for businesses that have never tried to collect. It's very customer friendly, allows them to salvage that relationship if they need to. But at the same time, if you have a very extensive collections process, this layers into it very easily.
All right. Well, thank you, Stephanie.
Thank you.
That's all the time we have for today. We will all now exit stage right and bring in the next startup, which is Habit from New York City.
And I'm the co-founder and CEO of Habit. And at Habit, we are focused on a very specific problem within the insurance industry. That is sales. So selling insurance is actually very, very hard. And there are multiple reasons why it's hard. First, it's at product level, less value identified by the customer that makes them create like an impulse purchase. And second, the lack of contextual in the distribution side. So the right moment to sell the right product to the person. So at Habit, we are focused on bringing context to product. We are focused to bring context to distribution. How do we do it at product? At product, it starts by understanding the day in the life of a person. So we understand how you commute. What does it mean when you commute? Are you walking a dog? What does it mean when you're walking a dog? And we use that information so we can enable insurance products that are based off more data, more relationships with other services, but also that could bring new business models. So either it's a usage-based product, either it's a product that understands the activity of my pet, or if the pet went out of a fence, or a product that is connected to alarms and reacts and creates assistance and deploys assistance and rapid response teams in the case of a need. And in terms of distribution, what Habit does is pretty simple. So we bridge the gap between carriers that have insurance products, some of them enabled by us, but some of them products that are out of the shelf, and the distribution players who actually have the large pre-existing communities. So Avid is creating here an unfair advantage on customer acquisition because we are actually not doing B2C, we are leveraging these partners. And these partners, in fact, are the ones that also benefit from new revenue streams, one more product on their shelves that is very related to their core activity, and more, they actually can influence and advise their customers. So basically what we do is we bridge both. How do we do it? Simple. We transform insurance products into APIs that are embedded into the distribution channel customer journey, and then while the customer is being shown information about insurance product or onboarded into the insurance product, we then bridge back the information to the carrier. What's very interesting is that we do it without the full integration with the carrier. So our technology is actually pretty cool on that part. That is, our go-to-market is much faster than a typical broker. So you can look at us as a broker on APIs. So in terms of market, we are starting small, but very but laser focused on specific parts of the industry. Of course, that our way of growing is starting very focused on the space, but then keep growing in a concentric way in terms of one, lines of business, second, expand to new geographies, and third, as we aggregate volume between distribution and carriers, we know that we will also be able to leverage this volume. In terms of team, me, my co-founder Sasha, we are two of the co-founders. She's the COO, I'm the CEO. Christine, she's our CTO, and Luis leads our all data analysis component. In terms of advisors, these are some of our friends of the company, people that are very involved within the insurance, within the industry, and that are very present in our day in the life. In terms of team, this is our team, and thank you so much for having us.
All right, and we're lucky to have with us here today co-founder and CEO Domingos Bruges, and we'll welcome him to stage along with our three judges. Judges, I will give you the 4-minute counter again, and the floor is yours.
Hi, Domingos. Question for you is your platform live in the market today, and what kind of success have you seen so far?
Yeah, the platform is fully available in the market. And we have two ways of approach the market. One, we are licensing technology, so we are across multiple players that have these products that I just demonstrated. But on the distribution side, this is a space that is fully regulated, and we started to operate small and within a very specific region that now we are trying to expand. So, but yeah, the answer is yes.
Hi there. You know, you touched on a question after it popped up, but I would love to ask for a little bit more information. That is, I know with connecting with insurance carriers, often those integrations take quite a bit of time. And I was going to ask how you did it. And then you said, oh, we just kind of connect through APIs. And I'm wondering if you could just talk a little bit more about how you're able to circumvent that typically very arduous and complicated process.
Yeah, I do believe that that's in fact one of our key advantages. That is not only in many or most of the cases, it's a long process to connect with insurance companies, but in some other cases, insurance companies are not even ready to expose APIs to the outside world. So the way that we solve that is we have a low-code, no-code platform, so a platform where we can represent the full details of the insurance product within our platform, meaning that the details that we are representing and the business logic of this product are then transformed into APIs. And probably our next question is, you understand that we can show information, we might even be able to sell, but then how do we report back to the carriers if they don't have APIs? So one of the ways that we do it is we export through legacy methods. So either from an Excel file, either from like a text file that we obviously send periodically. If the carrier has APIs, then we connect with APIs. If the carrier has one of the well-known core systems from the industry, like Guidewire, The Creek, then we connect to those ones. Thank you.
Western Southern Life is an insurance company, and specifically a life insurance company. Could you talk a little bit about the earlier question that you've gotten some traction, or what products have you had traction on, and is any of it been in life insurance?
Sure. So today we are very focused on PNC and most of our activities within PNC. The first products that we deployed that we started to distribute are within personal accidents, very focused on sports, playing, or accidents that have a very specialized context to be sold. And we are doing the first steps on testing and trying out life insurance, where the channel to distribute their product is once again very contextualized. So we try to target and to partner with distribution channels that bring back to people, the prospects or the future policyholders, the context on why they should buy a policy or life insurance. For example, during maternity, or when you are a new parent, or if something is related to you that reminds you of the need of or the importance of that product. And basically, this is how we work. Distribute in context.
All right, that is all the time we have. Thank you, Domingos. Appreciate you tuning in for this, and we will move on to our next startup. Next up, we have Insure Life coming from Raleigh, and we look forward to hearing their pitch.
Camerata, co-founder and CTO of Insure Life. I have one successful technology exit, and I've personally helped insurance companies digitally transform. Insurance distribution in the U.S. is antiquated. The current model leaves tens of millions of mass market consumers underserved and underinsured because it's not profitable for agents and advisors to help them. Also, both clamor for an immersive digital experience and a connected work environment, now made a requirement by COVID-19, but insurance distribution has been slow to adopt for a long time. Insure Life fixes these problems. We help insurance companies grow by connecting all insurance distribution participants around our network orchestration platform, including consumers, agents, insurers, and regulators. They interact virtually anytime and make it worthwhile for agents markets needs by blending the convenience of direct-to-consumer with agents' human touch, all from their smart devices. And for doing this, Insure Life makes money on every transaction. A quick market look shows a big thirst in the insurance distribution space, with Prudential's $2.5 billion acquisition of Assurance IQ, the $914 million IPO by GoHealth, and Integrity Marketing Group's $945 million financing for growth. We're different because we reimagine the agent's role in a contactless world. We provide agents with a virtual platform and community where they're coached, supported, and educated. Increased agent engagement and retention trickles down to consumers as exceptional customer experiences, creating happy, engaged, and loyal consumers who buy more things from you in the digital era. Let's take a look at how we do it. Our platform is akin to a fully managed Shopify for insurance companies. We onboard their products, and they get their own digital experience to pull consumers to their products. We are not a marketplace. We help insurers sell and cross-sell its products to new and existing customers. Consumers receive personalized insurance advice and easy-to-understand 20-second videos, recommendations for that insurer's products, and access to agents via video, voice, or chat. Now, let's look at an example. Nancy is pulled into our platform via Facebook, one of the multiple channels used to acquire high-interest consumers. Nancy's nearing retirement and targeted with an exclusive personalized ad. Nancy's compelled and clicks through to our consumer experience. She enters her email, home address, and a little about herself. She then receives objective insurance advice, personalized insurance recommendations, and access to agents. Nancy receives a tip for Medicare supplement insurance and sees the 20-second video of advice. She also sees a personalized recommendation for that insurer's MedSup product. Nancy is interested, so she connects with an agent, Jane, via one-way video call. She can also connect through voice call or live chat. In our pilots, 13% of consumers who came into our consumer experience and watched a video interacted with an agent. Once Nancy connects, she speaks with Jane, who offers objective advice and follows our exclusive virtual sales process. Jane is a licensed agent who has onboarded onto our platform. From our agent experience, she teleworks from home anytime and receives free, live, inbound calls from high-interest consumers. All she needs is a computer or smart device, because our platform is natively in the cloud. Jane answers Nancy's questions. If Nancy wants to start an application, Jane validates our platform's recommendation and follows our proprietary virtual sales process. Our platform integrates with an insurer's existing tools or connects to their APIs if available. From our pilots, 20% of consumers who interacted with an agent purchased a policy. Once the call ends, Jane sees how much she made. She's paid by the minute for her service and a small bonus. The average agent sells 4 life insurance policies per month. From our pilots, an agent can sell up to 4 a day. We record and analyze sentiment and structure of all communications with IBM Watson to detect bad actors and coach agents when they need help, improving their service level. Insurers and regulators also see this information to answer important questions, like is the customer satisfied? Did the agent follow proper protocols? And was the insurance product sold as intended? Back to Nancy. After the call, Nancy rates her customer experience. She also sees recommendations for related insurance products from the same insurer, including life insurance and protecting your retirement money with a fixed index annuity. We also re-engage consumers like Nancy on our platform. As we track our life events, we create an engaged, sticky consumer by giving her easy-to-understand insurance advice and access to agents anytime, anywhere. Insurance companies get engaged new customers and cross-sell opportunities. We expect our proprietary platform can achieve 95% first-year persistence. Insurers like Western and Southern can use our platform to reach new customers, and it complements their existing distribution partners like Fifth Third Bank. The insurer pays us a commission on new business placement and renewals, just like any digital agency. We're currently engineering our minimum viable product and are roughly 6 months out from launch. We've successfully raised 2 rounds of funding and signed up 1,000 agents on our wait list. Recently, an insurance company in Hartford, Connecticut invested in our current round and will be launching with their Medicare supplement product. We're seeking investors for our open seed round and also seeking insurers who want to collaborate and grow their distribution in innovative new ways. Thank you.
Right, and we are back. Apologies for momentarily losing the feed there. The judges and John could both hear each other and continue on, so we finished out the Q&A for InsureLife, and we're ready to move forward to the next startup now. Thank you for your patience again. So next up, we have Earnestly from Cincinnati.
Greetings, everyone, and thanks for the opportunity to share our story today. My name is Ryan Reibold, co-founder of Payload, a fintech platform I launched in 2019 alongside Ian Halpern. Payload is a developer-friendly technology stack powering both ACH and credit card payments, but more importantly, eliminating manual check payments. Earnestly is a group of the Payload technology at work, enhancing how payments take place in the real estate world. Zach Jacob will tell the story of Earnestly. Zach recently left corporate life to join the Payload team and is responsible for the Earnestly platform. Take it away, Zach.
Thanks, Ryan, and good afternoon, everyone. First, I'd like to offer a little insight into the real estate industry and its movement through this age of digital transformation. Over the past few years, many real estate companies have adopted digital processes such as e-signatures, document and workflow automation, and of course, digital marketing approaches. We've found 2 key areas that are due for innovation: the payment landscape and the funds disbursement at the closing table, and how this payment data is ultimately tracked, recorded, and reconciled. This is why we built Earnestly, to automate and integrate the capture and reconciliation of real estate payments and streamline the funds disbursement after closing for the 6 million and growing yearly real estate transactions. The Earnestly journey all started with the earnest money deposit payment, which is traditionally a very inconvenient payment process for virtually all parties inside of a real estate transaction. The buyer typically writes a check that has to coordinate the delivery of that check to either the real estate office or the settlement company, and is usually required to do so within a 72-hour window. We're finding certain generations don't even have checkbooks these days, so they're delivering the funds via cashier's check or money order, or paying for that expensive wire. Then on the back end, finance administration processes and records each payment manually. And for large organizations, this can easily be upwards of 1,000 payments per month. All in all, a very tedious and ultimately an expensive process for this one-time, time-sensitive payment. And through our conversations problem solving for the earnest money deposit, we quickly realized manual payment processes exist in other areas, such as in agent fee collections and commission disbursements. For agent fee collection, it's common for agents to be invoiced on a monthly basis for things such as brokerage dues, copier or marketing fees, insurance payments, the list goes on. Typically, invoicing for these fees is a very manual task for administrators, and the collection processes are all over the map. There's checks, credit card processing using third-party merchant services, ACH through the bank. It's a mix. This creates a very time-consuming and, again, manual reconciliation process on a monthly basis for accounting teams. Commission disbursement processes aren't quite as tedious administratively, but still typically involves a physical check and a multi-step process. So, leveraging the systems that the real estate companies have already invested in, we've created multiple integrated payment workflow options. Some as simple as a secure payment portal embedded on the company website to fully automated solutions, such as our Earnestly agent dashboard, which is ultimately populated through live feeds from existing core systems. Not only do agents have the ability to send a one-touch earnest money payment request to their buyers, then receive alerts as they make their payments, but through integrations with the brokerage's back office system, agents can receive their monthly invoices and commission disbursements here as well. Agents can store their payment information in the dashboard, whether it be a credit or a debit card, and if they prefer to pay via mobile device, we're certified with both Google and Apple for Google Pay and Apple Pay. This way, they're not required to enter a credit card or a bank account number each time they're making a payment, just a simple one-touch payment. Accounting teams can also use these stored payment methods for auto drafts. And for commissions, agents can add their bank account information, which can be used to accept digital commission payments. And once again, payment exchange details flow back to the real estate company automatically, creating happy administrators and business owners. So as you can see, we're certainly not a one-size-fits-all payment platform, which fits very well inside of the dynamic real estate industry. The versatility of the Payload platform empowers us to customize each Earnestly solution specific to our partner. We believe our ability to provide this unique experience, along with the increasing pressure for organizations to transform to digital, has driven our rapid growth here in 2020. Looking at 2021 and beyond, we see a huge potential for continued innovation in the real estate payment space, and we're confident Earnestly and the Payload technology stack will lead the charge. Being almost completely self-funded, a financial prize would be huge for our marketing efforts, and we truly appreciate your vote. So thanks to the FinTech Frontier and everybody who's joined today. Take care.
All right, and with us today we have Zach Jacob, the VP of Business Development, who you just heard from, to join for our Q&A, as well as our judges moving back into the room.
Well, I have a question because I just had to go through a closing on a property I own. And I asked this, in what I've done, it seems like just very common to ask it. But when I was listening to the presentation, I kept thinking, oh gosh, in this process, just one more app. How do you get over that objection?
Yeah, that's a great question. And that's probably our single biggest differentiator when we're talking differences between us and other digital payment platforms. So our strategy is not to be a different app. We quickly understood, learning the landscape of the real estate industry. There's typically 5 to 6 core platforms or software systems that are already being used by the agent base and the admin team. And we didn't want to introduce that 7th system or make them download an app to be able to use the system. So we're leveraging our developer-friendly API to integrate and really coexist among these key systems. That way buyers, they're receiving a request in their email that just allows them to really just hit a pay now button. And then agents can be within their CRM or their transaction management system, hit the button that sends that request off. So it's not another app. It's not a requirement to have an app. It's web-based and accessible via any computer or mobile device.
But just to build on that, would it then be integrated into the offer and signature workflow that others have, like a dot loop experience?
Great question. So yeah, we found that we live best in the transaction management space. So there's 3 core systems that usually live in that or that are, I guess, the market leaders in that space. So we got SkySlope, dotloop, and DocuSign. So yeah, we have active integrations with all 3.
Thank you.
Hi, Zach. You mentioned ACH. So who's currently processing your ACH payments on the back end, and what's implemented on your end to protect yourself against fraud?
Good question. So we use 2 of the leading ACH processors, so Forte and iStream, and they carry the highest level of security compliance certifications. And we also, as an organization, we have a proprietary network-based encryption, system that encrypts any credentials that are being entered in. So we're not actually seeing that data, and the data is encrypted to the highest level. So, and also to build on that, we do carry a PCI level 1 certification, which is the highest level in the industry, which helped us get through like the Google and the Apple certifications. As you can imagine, those security clearance processes are pretty strict. So,
getting back to Stacy's question, can you tell me a bit more about your continued customer engagement? It sounds like as she was describing, you're signing up a lot to write one earnest money check. What would be the continual engagement with them to then also link into commissions and other work?
Absolutely. So that's another huge differentiator of ours. So we're positioning ourselves to be really the one stop for real estate companies to take care of all of their real estate payments. So the earnest money deposit was kind of the quick win, I guess you can say, especially when COVID hit, just because it became very, very, I guess, needed. And then once organizations began to see the positive feedback from their agents and their buyers, it's just kind of caught fire really across the country. But yeah, being able to leverage our ability to accept multiple methods of payment and the payload technology stack, which is ultimately the engine that runs Earnestly. The options are endless. So our continued customer engagements, usually phase one is the earnest money deposit, get that going, and then let's expand. Let's expand and coexist within your other systems and automate all your payments.
All right. Thank you, Zach. Thank you, judges. We will all of us exit and move on to our next startup coming from Pittsburgh, which is Honeycomb.
Hi, my name is George Cook, and I'm the co-founder and CEO of Honeycomb Credit. I'm a sixth-generation community banker, and I learned firsthand how rapidly the community banking industry is consolidating. We lose one community bank every day, and that's transfer loans flowing to Main Street small businesses. Filling the gap left behind by traditional lenders are online lenders, from fintech startups like Lendio or Fundbox to Silicon Valley incumbents like Square or PayPal. They make up a huge percentage of the market. They're growing like crazy. But unfortunately, a recent study found that their average interest rate is 94%. 94%. That means it's getting harder and more expensive for Main Street businesses to access fair capital, and that a $600 billion a year industry is being overlooked. That's where Honeycomb comes in. We've built a first of its kind loan crowdfunding platform where locally owned businesses can borrow fair capital from their own customers, community members, and fans. To help understand how it works, I'd like to introduce you to Casa Brazil. Casa Brazil is a popular Brazilian restaurant in Pittsburgh, Pennsylvania. They applied to Honeycomb, went through our rigorous due diligence process, created a campaign page, and then all that campaign with their customers and fans, receiving over $90,000 investment in their campaign. But Kayla and Tim got a whole lot more than just cash. They were able to tell their authentic growth story. That generated a lot of media attention. And that built buzz around the business and allowed them to get new and old customers alike coming to check out the business. They now have more than 70 people invested in their long-term success. And we know that those investors who have skin in the game are turning into real revenue for our alumni businesses. In fact, our average Honeycomb alumni is seeing a 33% increase in year-over-year revenue after running a campaign. And Casa Brazil isn't alone. We've deployed more than $2.5 million to over 100 small businesses, and our success rate is over 83%, compared to an industry-wide crowdfunding success rate of about 25%. What's more, we're able to do this across the country and with a diverse group of business owners. Our nationwide license allows us to work anywhere, and we've already done campaigns in 17 states. 55% of those deals have been in low to moderate income communities. Half are for women-owned businesses, and 25% for minority-owned businesses. But the real secret sauce for our go-to-market strategy is our customer acquisition flywheel. When we work with great businesses like Casa Brazil, they're sharing with their network of fans and customers, letting them know the importance of investing local, getting them signed up and invested, and those investors are sharing, and about 25% of them are also investing in other campaigns, allowing us to acquire investors at a very low cost. as Casa Brazil is sharing their campaign, other business owners are also learning about Honeycomb through emails and social media and in-store collateral. That allows us to build trust and brand awareness in these really tight-knit networks of small businesses and keeps our acquisition costs low. This creates a powerful customer acquisition flywheel on both sides of the market. In fact, 75% of the small business deals we've done have been direct or indirect referrals. And that flywheel is really starting to pay off. We've doubled the number of transactions we've done over just the past 2 quarters. And I'm confident we've got the team to win. In addition to my community banking background, I also have big data credit analytics experience with TransUnion and Zest AI. My co-founder is an investment banker turned small business owner, and our COO has a deep hedge fund operations experience, so he knows how to navigate the SEC and FINRA. And we've assembled an amazing team of entrepreneurs, small business enthusiasts, and lenders who are passionate about fixing small business finance. Thank you so much for your consideration, and I hope you'll consider joining us on our path to rebuild Main Street. Thank you.
Okay, let's bring co-founder and CEO George Cook to the stage, along with Jim, Jesse, and Stacy. Judges, you are on the clock. You have 4 minutes.
George, what is the typical interest rate and term of a typical loan?
Yeah, so our loans are typically 3 to 5 year fully amortizing loans, ranging from 5% interest rate up to about 14% interest rate. So on the 5% side, we can be pretty competitive with SBA loans or other programs. And getting up into the higher tier, we can make loans that some traditional lenders might not be able to do.
How have the investments gone so far?
The portfolio has been performing exceptionally well, despite all of the pressures in the portfolio through a global pandemic. We've only had 2 defaults. Both of those defaults continue to pay as agreed, even though the businesses were forced to shut down. And I think that's a testament to both our due diligence process, but also this idea that when community members are voting with their wallets, that's both a powerful signaling mechanism about which businesses are a good fit for the community, but also a de-risking tool because we're seeing it change behavior and we're seeing these consumers shop at these businesses more and support these businesses.
Well, I went out to your website and representing Cincy Tech, I love the hyper-local focus. But you know what? This is the first time hearing about Honeycomb. Could you talk about your go-to-market strategy to have more people in every bucket, whether they're the investors or those seeking investment, know about you?
Absolutely, and we're thrilled to announce that we're going to be launching our first Cincinnati campaign on Monday. So check back on the site there then. And one of the really exciting things about our go-to-market strategy is that we can focus with an inside sales team on finding great, well-respected small businesses in a community. If we can bring those businesses to the platform and give them the customer success tools they need to activate their network, then they are shouting from the rooftops that they're working with Honeycomb because they're trying to get investors to invest in that campaign. So that brings those investors onto our platform at a very low cost. It also builds this brand awareness and trust within the small business community and allows us to activate entire cities or entire geographies by simply onboarding 1 or 2 small businesses. So we're really kind of inverting the whole customer acquisition process for financial services because most people, even if they have a great experience with their bank, they're not walking out of their loan closing and getting on Twitter and telling the world that they just closed a loan with their bank. So we're able to make that a really social, viral experience.
Do you talk a little bit about your metrics, about your investor mix versus your size of your investor pool versus your opportunity pool to lend to?
Yeah, so in terms of the investors on the platform, we have over 1,500 active investors at this point. We've seen over 3,000 transactions. We find that about 25% of the investors that come on through one deal are cross-pollinating and investing in multiple deals. In terms of kind of the average investment size per investor is typically around $1,000. We see investments as small as $100. We've seen investments as high as $25,000 or more. The average loan size for the business is anywhere from $20,000 on the small end up to we're going to have our first $500,000 campaign coming up soon. And really, if you think about kind of the small business lending ecosystem of loans of $500,000 or less, that market size is over $600 billion. So very, very large.
Right. Thank you, George. We appreciate the time today. Thank you for the questions. We're ready to jump into our next startup, which is hailing here from Cincinnati, Mortgage Bite.
You in the market for a new home loan? Whether buying a new home or refinancing your current home, it's important to shop different lenders. Nearly 50% of mortgage shoppers only talk to one lender, possibly costing them thousands of dollars over time. Mortgage shopping used to require calling different lenders on the phone or driving to their offices. The internet has made it much easier to shop online for a mortgage. The problem with shopping online is the comparison websites offer you teaser rates to get you to click. Other websites make you fill out long forms and then sell all your data to many different lenders before you ever see an offer. Those lenders then overwhelm you with too many phone calls and emails. Mortgage Bite is a first-of-its-kind mortgage shopping platform where mortgage lenders compete for your business in an auction-style marketplace where your contact information stays hidden. Whether you are looking to get pre-qualified or are ready to apply for a mortgage, Mortgage Bite makes it easy. Get started. Simply enter the estimated details of your mortgage and your contact information in less than 60 seconds. Lenders will start making you customized offers in no time, and your contact information remains private while you receive offers. Simply select the best offer you receive, and you will be connected directly with your loan officer. Mortgage Bite is the best way to shop for a deal on your mortgage stress-free. Mortgage Bite. Shop for your mortgage, save money.
Well, people coming into an office and asking for a mortgage in the current climate is just not happening. Internet lending or internet leads business started off very sloppy in the beginning. Most of them weren't too successful because they were competing against all these people calling them on the telephone.
Hi, my name is Issa Nasser, and I'm from Cincinnati, Ohio. My company is Mortgage Bite. Buying a home for most people is the largest financial transaction they will ever take part in their life. A study completed by the CFPB found that 47% of homeowners failed to shop more than one lender before choosing a mortgage offer. There exist many problems for consumers with typical methods when shopping for a mortgage, such as multiple credit pools that will negatively impact your credit score, potentially even disqualifying you from being approved for a mortgage, among many other factors. Consumers may save substantial sums if they consider the product offerings of multiple lenders or brokers. Mortgage Bite helps consumers by bringing mortgage lenders directly to you and connecting you with the lender that provides you with the best possible offer on your home loan and without the need for multiple credit checks. The top 4 mortgage lead generation websites account for $500 million in revenue each year, with the mortgage advertising market as a whole totaling $1.7 billion. In 2019, there were a reported 15.1 million home mortgage applications, proving there is a significant market opportunity available, even at nominal market share levels. Mortgage Bite's first ever customer realized offers that spanned a large range of closing costs from $900 to almost $8,000 and a difference in monthly payment amount of $150. We've designed, built, and launched the world's first mortgage shopping platform. We've realized increased traction over the past few months in not only borrower mortgage submission, but we continue to acquire new loan officers on our site completely organically at an average of 1 to 3 accounts per week. Currently, we have 30 professional paid or trialing accounts, along with a total of 420 loan officers that are verified and licensed on Mortgage Bite and cover 45 states. While typical mortgage lead costs with competitors like LendingTree range from $40 to $125, with a typical close rate of 3 to 5%, Mortgage Bite leads were intentionally priced low during our market validation efforts and have already been considered undervalued, given their exclusivity and with higher than expected response and close rate. With a total of 327,800 loan officers reported in the United States last year and 15.1 million home loan applications, our conservative projections of a 0.25% increase to 1% of the market by year 4 show rather healthy yet intentional growth year over year. Due to already lower than average customer acquisition costs, we've seen a significant increase in the thousands of percent in new traffic to our website, which only continues to grow. Mortgage Byte's mission is to provide a simple, stress-free shopping experience that gets you the best deal on your mortgage. That is why Mortgage Byte is free forever for anyone buying or refinancing a home. Today, I'm asking you to vote for Mortgage Byte as the best possible solution to enable the critical financial support for homeowners during what is typically one of the largest purchases of our lives, especially during this new world of COVID-19.
Buyers want to have somebody that they trust. The future of the mortgage business is online.
All right, let's welcome co-founder and CEO Isa Nasser to the stage.
Hi there.
Hi, Isa. I have a question. At what point in the process does like the due diligence happen, credit, et cetera, from a borrower's perspective?
From the borrower's perspective, the credit checks currently happen with the loan officer. We anticipated implementing a credit check feature eventually, but we wanted to first test the market, get some momentum before implementing that feature. So as of right now, there is no credit check until they actually connect with the loan officer.
And that sort of tees up my question, which is really, could you just talk about where in your journey from a product and sales or revenue standpoint are you?
Yes, very good question. So we actually have seen a significant increase, as I mentioned in the video, of thousands of percent in traffic and reach starting February 5th. So we all know what happened starting in February. So it's apparent that the market is looking for tools and methods to shop for a mortgage. We kind of have proof given that data in our analytics. As for our go-to-market strategy, which is what we anticipate happening next, that's where we want to focus on a specific market and start validating the results through our mortgage leads that we've generated thus far. Sorry.
And so we totally understand about the dog. I got a dog during quarantine for the first time myself.
It's like the worst timing. But did that answer your question?
Yes, thank you.
Mm-hmm.
Essa, could you, I was trying to learn a little bit better here. You mentioned the loan officers. Are you signing up the loan officer and paying them and getting paid the lead from the loan officer to effectuate the mortgage, or are you linking ultimately up with the bank?
Yes. So we are targeting individual loan officers and small brokerage firms at first until we kind of move into the larger bank space. The only fees that we really charge are on the loan officer side, and they are obviously already paying a large amount of their budget with competitors like LendingTree or even just click leads through Bankrate and things like that. We're much more differentiated.
Okay.
So that's
and quick follow-up. What's the mix of your business so far between refi and purchase of home?
Actually, we are at about 80% purchase loans currently and about 20 refi. So majority is purchase. That was our target at first. And the website was built ideally with evergreen content in mind. So we are organically reaching a lot of customers right now because of that investment that we made early on.
How are you reaching out to homeowners to expand for them to find you?
So that is currently organic, and we have recently started ramping up our digital marketing efforts. We have a very robust and well-functioning mortgage calculator, which is one of the biggest search terms on Google in the mortgage and finance space. So we are realizing a great conversion rate just by targeting loan mortgage calculator keywords and our outreach that way as well.
Thank you.
Mm-hmm.
All right. Thank you for your time, Isa. We appreciate it. We are ready to jump into the next video. So next up from Cincinnati, we have We Prosper.
Good afternoon. I'm Will Carter, and on behalf of the 5 members of our team, I'd like to say today we are living with one of the American dream's gravest threats, the Black wealth gap. Our country's 400-year legacy of racism has created a disparity that Citibank's latest report values at over $17 trillion. $2.7 trillion of that is lost income, with the average Black wage cut in half. The result? Half of the 16 plus million Black American households are currently valued at less than $1 in wealth. Now, people might be saying, wow, that's too bad for them. But the wealth gap affects all Americans. Ever seen urban neighborhoods in blight or waning shopping venues like Forest Fair Mall? Ever wonder why our social services are overburdened or our schools underfunded, even though taxes keep rising? These outcomes and many more are the result of a lack of wealth that would typically be used to fill the wants and needs. Studies show Black women are paid roughly 60% of what a white man would be paid, yet they are the highest educated group in the nation. So it is no surprise that they start businesses at 3 times the rate of other women. Yet the wealth gap stifles them as they are almost completely excluded from venture investment while also seeing higher decline rates for business loans. Because of the wealth gap, friends and family cannot or choose not to fund Black-led efforts because they fear losing their investment to underfunded businesses. But wait, wasn't crowdfunding and crowd investing supposed to fix all this? Well, here the wealth gap strikes again. Our community looks at the offerings and says, why invest $20 or $100? That's not going to fix anything. Or why give dollars to them? They look no smarter than me. Or how do I pick a winner? This is a gamble I'll likely lose. Each concern is a showstopper due to the fact that Blacks possess only about $6 for every 100 in white wealth. So the desire for gains is outweighed by the perception of unmitigated risk. Doesn't it just make sense to entice this wanting group to participate in the venture economy by solving their concerns? Imagine investing where you know the ventures will have the funding to succeed and where the outcomes have a positive impact on the wealth gap hindered community you care about. Collectively, this means your community wins, the ventures win, and you win by building your wealth. With this in mind, we redesigned the crowd investing model to counter the concerns created by the wealth gap. First, capital is aggregated at an affordable rate, just like paying a cell phone bill. So our market can now afford to participate. Subscribers pay in just like they would a 401k account. Second, employees of the platform execute in their roles to yield better startup outcomes. So our market trusts that we as a company will grow successes. Third, we focus on building success in and for our community, creating an impact that our subscribers can feel passionate about. So the big idea was to build a platform to pool funds first, which would enable us to build ventures better as a central entity. What do we call this platform? We call it We Prosper, a platform designed to allow our subscribers to build their wealth by growing the wealth of our community. We started with the concept of pooling our power and solve for points of friction along our model's journey. We had to answer questions like, can we even get someone to make an investment together? Yes, that was Popsy Cakes. Can we use our big company know-how to move the community to action? Yes, that was Heart and Soul Run 5K. Our struggles in funding our initial efforts were solved when we launched the subscription feature. Then we used a partnership as a low-risk pathway to our first business execution. From there, we founded an auto transport firm named CMBTI as our first fully in-house execution. We plan to achieve minimum viable scale at 1,000 subscribers in 2021 and anticipate growth to over 100,000 subscribers by 2030. WeProsper.com will attract an entire demographic to access the venture economy using a convenient and affordable option that they trust. Our motto shares our mission. Together we dream is for the vision of a better future. Together we build is for the action we'll take to achieve it. And together we prosper is our community finally prospering in a way that it hasn't before. Where else can you invest to impact yourself and the entire community at the same time? That's why we say, together we dream, together we build, and together we prosper. Thank you so much.
All right, thank you, Will. Let's bring co-founder and CEO Will Carter to the stage. Will, we will welcome you back along with our judges, Jim, Jesse, and Stacy. Here we go. Okay. All right. Thank you, everyone. I will leave you with 4 minutes. And Jim and Jesse, feel free to kick it off as Stacy is joining here shortly.
I'll start off real quick. Will, can you make sure I'm understanding this? Through the subscription model, you pool the funds together, and from that pool, you make investments in the respective opportunities?
This is correct. We pool everyone's funds together, and then we actually go and do the startup And in that way, we control the quality of the execution. Control the quality of the execution, you get better outcomes. Those outcomes are the outcomes that our community trusts and want to see.
Thank you.
I'm curious about how you've looked at challenging scalability concerns when there's so much of your human capital involved in enabling the investments.
So you're saying, how do we scale when our human resources are going to be needed to actually run businesses? So
that's a clear way to say it, yes.
So this goes back to our corporate experience. My experience at Procter & Gamble was going and starting up both ventures and technology. And then once we got through the startup process, we went through what was called TT&T, where we would cycle off of the project and onto another project and leave that venture for operations to continue. Similarly, we would do that with our ventures. After we do the startup process, our startup team cycles off and all those skills cycle off as we onboard through technology transfer and training. So we're just reapplying what we did at our Fortune 500 companies.
Thank you.
Well, can you help us understand how your company makes money?
Yes, so we target roughly 12% gross profits for our businesses. We make a profit once those businesses make that 12%. 8% of that money goes back to our investors, and then the profit sharing is on top of that. So if they make 12, then we get 2, and our members also get another 2. In total, they would get 10. The goal is to target businesses that do 12% gross margins or above that. And of course, profit sharing is everything above 8%.
Will your platform be accessible for personal as well as corporate investments in the pool?
We're focused on personal investments. Our community, typically, we're looking at opening access to the community at large and in general. So we're really focusing in on the individual that is looking for that way to grow their own generational, their own personal wealth. That's who we're focusing. That's the niche we're focusing on right now.
Sorry if I misunderstood. I was meaning the investor. So the investor investing in the pool that ultimately invests in the company, will those potential investors in the pool be both individuals as well as potential companies or funds that can invest in your fund?
We're focusing on individuals.
Gotcha. Thank you.
I apologize for the feed. I don't know what happened to the camera there, but been an interesting day from a technology standpoint.
Sure. No, it worked out well.
All right. Thank you, Will. And thank you, judges. Appreciate the time. We will move on to our next pitch now. Next up from Columbus, we have Flurry.
Flurry's mission is to enable immigrants protect the people that they love no matter where they are. Our goal is to provide health insurance for less to cover people back home. The problem that we're solving is this massive gap in transparency when it comes to remittances. You see, millions of people leave their homes every year to travel abroad to strive to provide care for their family members back home. Now, they usually do this by sending remittances. When you do send remittances, there's no way of knowing whether the money that you're being asked to send is actually going to go towards supporting the person you're sending it for. And when you do actually end up sending it, you realize that there's no way of knowing if at any point in time it has actually been used at the right place for the right purpose. Flurry is creating a marketplace for immigrants to be able to compare and buy health insurance so their families back home can get access to better care. We're creating an efficient, frictionless way to provide better health care for millions of people in emerging countries. While we're solving a significant consumer health problem, there's also the huge problem of healthcare financing in emerging markets. Private health insurance in places like Ghana and Nigeria remains at a very significant low percentage of around 2 to 3%. This is primarily due to a lack of discretionary income and a lack of creativity in the solutions around insurance. Our solution allows us to be able to connect insurance companies in these countries to a new market that has a greater propensity as well as a better understanding of insurance. The market potential for what we're creating is a $12 billion market focused on 25% of the remittance spend sent to Africa as a start. We're building a product that is highly scalable and applies to multiple markets of immigrants who all send money home to protect their families. Our revenue model is pretty simple. We make money two ways. One, a transaction fee that we charge the insurance company for listing their product on our marketplace. And then two, a margin that we make off of the markup from the base price of the insurance. Our go-to-market strategy is focused on the target countries that we wish to provide coverage in and the corresponding immigrant populations within the U.S. and outside the U.S. Our focus on customer acquisition is through targeted, trusted groups, active social groups that put immigrants together, as well as the religious and community groups that we use to reach them en masse. In the current market, looking at the competitive landscape, what we have is a number of solutions that all fail to provide high speed to care and transparency as a solution towards healthcare. Flurry's solution is focused on working with insurers in the countries where coverage is provided, giving us a high response time, as well as the high transparency to the immigrant families trying to protect the people they love. Our team is made up of very capable individuals who have had several years' experience within healthcare consulting, starting businesses, and building technology for medical products. Our ask is a $650,000 pre-seed investment on a standard safe, with our milestones over the next 12 months focused on customer acquisition and product development. Thank you.
All right, thank you, Sam. And we are going to bring in our final contestant, who is from partially here in Cincinnati, partially a little bit further west, splitting time. We're glad to hear from Rent.
Nathan with Rent. I'm going to be speaking with you about the inefficient rental market that's not working for anyone. It really comes down to a resiliency problem. The entire rental value chain is reeling. 40 million people are at risk, 12 million in default. And as a landlord, the biggest problem you face is finding, keeping, and managing good tenants who are often marginalized because the bad tenants are consuming all your attention. And you have no community analytics. You may use a screening tool or reference or credit report, but they fail to understand the ongoing tenant health or identify great tenants because they've had a bad experience, like a global pandemic that's caused them to stumble. This leads directly to avoidable default, turnover, and eviction. And if you're a good renter, you spend all this time doing the right thing, paying your bills on time, putting a ton of good into the world that you never get credit for. The only time you get attention is when you stumble. Our platform, we're the solution. We capture all that good, that virtue, aggregate it, and turn it into an objective score that enables landlords to appreciate just how good of a renter you are. We build credit with traditional credit bureaus and connect people to community services and programs. Landlords get better tenants, and tenants get easier access to better housing and communities. And this improves retention and efficiency. And we have quite a market. 36% of Americans rent. and 50% of those renters live in 40 markets. Our focus is student and affordable communities, a $100 billion obtainable market. And we're approaching this market leveraging B2B sales and engaging channel partners. We have relationships with REITs, NGOs, and housing authorities, and are able to demonstrate a low customer acquisition cost for our wallet, which is important because retail banks are paying upwards of $200 to acquire new banking customers. And no one else is doing this. As you look across the landscape, most companies focus on facilitating that tenant to landlord payment, thus reporting rent history only. We are landlord agnostic, meaning we follow the renter, establishing a persistent profile that measures progress and delivers wallet and clearinghouse activity, all while building credit not only with rent, but also with recurring payments to gateway, community, and access. That's why we're driving to market. We've delivered the website, validated the problem, validated the idea, carried the majority of the lift ourselves. We've won conferences, participated in Accelerator, locked up our IP, and post-COVID, renewed focus on credit and community. We have relationships with leading partners in payments and 2 of the 3 credit bureaus to deliver the first renter persistent profile that aggregates transaction and behavior history while building credit without debt. Furthermore, we facilitate connection, community, and social programs to promote access and financial inclusion. This utility provides landlords entirely new data to find, keep, and manage good tenants. And just like an employer would pay SAP to improve resiliency or retention, landlords pay us to do the same thing. But because we're a wallet, we take advantage of exchange fees. And because we're an aggregator, channel partners, cable providers, financial services not only market us, they pay for the insights that we're creating. We deliver efficiency in our obtainable market, which creates substantial revenue. We're focused on density and data in our market, but we won't need much validation before moving onward because this tech is unlocking so much value. I'm an executor, I'm a builder. I've assembled an incredible team with experience in marketing, operations, architecture, as well as deep experience in data science, as well as incredible advisors with the relevant knowledge in multifamily and credit to help us take advantage of the timing. Governmental mandates are in place to provide access to credit and capital for underserved populations. OCC Project Reach, what we're doing. So if you're an investor and you want to bring efficiency and resiliency to this market that's going to create a lot of value for everyone, including you, we need to connect. Please connect with me on LinkedIn, take a picture here, text me. Rent is the social fintech on the frontier, providing access to credit and capital for underserved populations. We are the solution to this billion-dollar problem that's affecting millions and millions of people. Thanks.
Thank you. Today we are lucky to have co-founder and CEO Nathan Slafter here with us. So the stage, and we have Jim and Jesse, and looks like Stacy are all here. This will be the final Q&A. So judges, I will leave you with 4 minutes, and the floor is yours.
Could you teach us what your algorithm or method is for determining a good or what constitutes a good credit score based on the length of time that you've been in a lease? So if a person rented an apartment for 1 year and made all 12 payments, does that constitute a 700 score or a 720 or a 750? I'm trying to correlate this to how a landlord would be able to interpret it.
Thank you. Just as a point of clarification, in the future, we will have a proprietary kind of rent history or rent credit score. In the interim, we're using existing credit monitoring tools through 2 of the 3 credit bureaus, TransUnion and Experian. And by and large, FICO 8, rent history, recurring payment history, but now FICO 9, now is in market about 2.5 years, is actually taking into account recurring payments and rent history to establish your credit profile. And you can move from no file or thin file being because you don't have a credit or you don't have any loans to a 600 credit score by reporting previous transaction history up to 24 months, looking at like utilities, etc. So you can get a 650. Additionally, within 6 months of reporting credit history, so rent payments, you can build your credit by 40 or 50 points. Did that answer your question?
Yes.
Okay.
Hi there. Curious if you could go back. I know you shared the business model. Could you remind who is actually paying? And if it is a landlord, what size, what's the scale of those landlords that would be paying? Do they have to have multiple units, or just maybe I had more questions on the cost model?
Yeah, thank you. So what we're looking to do is augment the existing tenant screening tools. Right now at your fingertips are a turbo tenant or existing management. You also may have a reference or a background check or a credit report, but again, they kind of fail to identify what happened in a pre-COVID world. And so what we're looking to do is complement those efforts. And tenants, oftentimes that cost is passed to the tenant in the application, but they don't get to take it with them. So you apply to 2 or 3 places, you're paying that $30 fee on each place, and instead of that, we're having a repository. So the landlord could pass it to the tenant, but it persists with that renter. So when they move, they can take it with them. And this would be ideally for anyone, but we're focused on more of the mid-market housing authorities or REITs that serve these populations, usually 1,000 units or so.
It almost reminds me of like LinkedIn for credit score. You can take it with you, and so my thought is, how could you make it no cost to that population?
If I'm open to suggestions, we're actively exploring that opportunity, because that's our objective, is to be able to give people value that previously had been untenable. And this is one of the best ways to do it when it's already in their process, and now they can take advantage of it. So ongoing will be no cost, but it's kind of that initial look back that costs us quite a bit.
I see. Thank you.
I did have a question. So you mentioned that you're going to have an early launch next year. Have you done any early testing with any of your prospective renters, and what early feedback have you received?
Yeah, so we have a product in market now. You can download our apps. You can go to app.rent.ai. What we're able to do is pay rent, bill credit, earn rewards. So we're kind of facilitating that entire transaction history. We're integrating with landlords on platform management, et cetera. And what we recognize is we don't want to be a property management system. We want to really push towards this renter persistent profile. So that was some of the feedback that we got even from the landlords, is they're not able to see, even from property to property, if they use different management systems, renter behavior, renter history. And so so that was kind of the genesis of a pivot, if you will. And the feedback that we're receiving now is it's the holy grail for the industry. If you recognize the element to be able to incentivize virtuous behavior and reinforce it, but also something that measures progress, that delivers kind of a clearinghouse activity, this sets us up to either really accelerate or work with existing property management technology for acquisition.
Okay,
did that answer your question?
Our Q&A.
Sorry. Okay, thank you all.
Thank you, Nathan, and a special thank you to our judges today. That is the final contestant pitch, so we will move out from the Q&A now. Our judges are going to move on to deliberate on the winners, and you will also now see a poll on the right side of your Hopin screen. You should see the top right, chat, polls, and people. Select the poll, and you'll be able to vote. It's 3:26 now, so this will be open until 3:35. So please get your vote in quickly. Remember, that's just for your favorite startup pitch that you saw today. And then we will be taking those results and adding it into our scoring calculation. So hang tight to hear the full results. While our judges deliberate, I'd like to welcome John Steger and Brad Hoeller to the stage. John is the Director of Startup Services for Centrifuge, and Brad is a serial fintech entrepreneur, an investor and mentor here in Cincinnati. So John, Brad, welcome. And I will let you all take over. I'll be back shortly.
Thanks, Mark. And thank you, Brad, for joining us today. really appreciate you coming in to share a little bit of your perspective. For everybody watching us, Brad is kind of OG fintech in Cincinnati. So, Brad, can you share a little bit about your experience going back to going back a little bit of a way?
John, I think that implies that I'm old. Yeah, no. Yeah, I've been involved in fintech, I guess, since the mid '90s. I was lucky enough to meet some wonderful people back around that time, and we thought, hey, this crazy thing called the internet is going on, and people are going to want to buy things on that internet. So, I was lucky enough to be a co-founder in a company called Skipjack, which was one of the first internet payment gateways. And spent a number of years building that organization. We eventually exited to Fifth Third, the division that's since been spun out and has gone through a number of iterations from Vantiv to WorldPay, and worked there for a number of years with the great crew up there. But got the urge to build something new again. Left, sat out a little bit of time. And then got into some really new and exciting stuff that's going on specifically in the payment space, revolving around, it's called payment facilitation, which is, the model that Stripe and Square and some vertical SaaS companies like Toast and MindBody are using these days. Looking to build a payment facilitator tied to some vertical SaaS opportunities. So that's what we've been doing. I did a little bit of consulting as well around the payment facilitation space with, we had a group here in town called Fintech 513, and we consulted on with companies like Cabbage and WooCommerce and a number of other large companies that were looking at exploring the payment facilitation area. And now I've got a company called Pay Theory, where we're looking to solve financial problems for families and SaaS providers who service that industry.
Terrific. That's exciting. And I didn't mean to imply that you were old, but those of us in out of our 30s, the truth hurts. Have a longer view.
The truth hurts.
It's interesting. As a little bit of a finance interested, but kind of looking in from the outside, I think me and maybe others oftentimes think of fintech and the finance industry as really anchored in world financial centers, right? So, whether it's people in the trading pits in Chicago or London, New York, but the vast majority of finance and fintech innovation kind of happens there, Silicon Valley, and then everything else is sort of regional banking and fairly quiet. Obviously, that's not the case and hasn't been the case for some time. Do you see any kind of trends in where innovation comes from?
Yeah, I think you alluded to that. I mean, obviously, outside of the equity markets, the commodity markets, where you have some very specific centers, a lot of fintech actually for a number of years has been pretty regional. The Cincinnati area is very strong in the payment space as well as the insurance space. You've got obviously a number of regional banks. And you tend to see this around the country. So, you've got a number of fintech centers in places like Atlanta, Minneapolis, Phoenix, Arizona, Salt Lake City, for various pieces of the fintech landscape. And I think that's only accelerating now, right? I mean, you've got a general trend of disbursement in tech in general. And I think that, that existing regional nature, along with the fact that fintech and as we look at this specifically in our space, fintechs and software providers and SaaS companies are more and more coming together. So the fact that your SaaS platform for a specific vertical is now leveraging a lot of fintech companies to provide certain services, as an example of how I think that's going to continue to accelerate. And I think we're all now in a much better place when it comes to working remotely. Everybody's very comfortable with that, and with groups like Centrifuge and others in various regions really trying to promote the area and the strengths of the area. I think that only accelerates over time.
Yeah, in recent weeks, I've welcomed entrepreneurs to Cincinnati from New York, LA, the Bay Area. So it is not that we don't have wonderful talent, but we can always use fresh blood and new.
Absolutely, and you've got a ton of talent in the regional big co's, right? So, and those companies are innovating as well. So it's really I think it's a really positive force for especially regions like Cincinnati that have a really diverse group of companies and talent.
In your experience growing companies here, right? So a couple of times, have you felt that there was anything missing that you had to kind of go outside to find? And how would you compare your experience now versus, let's just say, a few years ago? And how things changed?
Well, some things were different back then. It was really a wide open space, and so we benefited from that. I was able to bootstrap Skipjack actually. So from that perspective, this has been a learning experience for me on the fundraising side. It's not something I necessarily enjoy, but it's a necessary evil, I suppose, in the startup world. And especially in the fintech spaces, a number of things have changed. It's a lot easier to get up and running now, and you can focus on driving more value. So, for instance, back when we built Skipjack, if we wanted to stand up a data center, we stood up a real data center. It wasn't that you just jumped on AWS. I think right now, to get the same amount of computing power and having regionally diverse data centers, that would have cost me or us back in the day, $5 to $10 million a pop. And now I'm getting the same thing for less than $1,000 a month, on AWS, for instance. But that also means that you have to move quicker. There are a number of fintech companies that specifically exist to solve problems for other fintech companies getting up and running, right? So, overcoming some of the, fintechs tend to have a little bit of a higher barrier to entry because you're dealing with more regulation, you're dealing with people's money or very sensitive data along the way. So, your MVP can't just be, let's put it out there in the marketplace and see what breaks. It's got to be bulletproof in many ways. You can iterate and you can go lean startup in certain aspects of your business, but you can't really be too lean when it comes to protecting sensitive data. So what's happened is, as a result, you've got this whole group of sort of fintech infrastructure companies that allow other fintechs to build that unique user experience, and work on customer acquisition and delivering very unique value add around the core bits of fintech.
Okay, that's actually really interesting. You hit on a place that I'm curious about, right? I would always have assumed that an awful lot of finance is about kind of matching cash flows and pricing risk. And as we start to see things fragmenting, disaggregating, innovating, whatever words you want to use, and rather than just big institutional players kind of always sitting in the middle, but peer-to-peer lending or smaller and smaller kind of less sophisticated entities, dramatically more opportunities for asymmetry of information and for people to kind of get in over their heads in terms of risk. Have you seen the regulatory structure changing? How do you manage that as a startup? Because there's got to be tons of complexity across states, changing federal regulations and so on.
Yeah, depending on which area of fintech you're in, there still can be a heavy lift. But like I said, there are a number of companies that have come into existence. I think about here in Cincinnati, you've got Phoenix, they're kind of split between here and Silicon Valley. But, like if you want to become a payment facilitator, if you want to, get up and running, you don't have to go direct to a payment processor and do that all yourself, right? They're kind of they're providing you a layer, And then you can also, in addition, partner with them and somebody else who's already tackled the regulatory complexities of this, and kind of piggyback on somebody else's knowledge and ability, right? And so to get up and running, it's not, there might be a reason as you drive more volume through your platforms to think about taking some of that cost out, or getting more control over your environment. But yeah, so what I would say is that those complexities and those regulations are still there, but there are people who are helping you solve them in the beginning. And then eventually, as you grow, when it makes sense for you to start to take on some of those responsibilities yourself, you're gaining that ability to not have to know everything up front. You don't have to solve every single problem up front now, right? You can really focus on what is that core value add, what is that problem that I'm solving. So I'm, rent is just sticking in my mind because it was the last, presentation there, but you saw a slide at the end of their pitch, where it had Experian, it had Stripe, it had Plaid, and those are all the kind of companies that I'm talking about, right? So Plaid for single sign-on, you had Stripe for your payments, you had Experian and one of the other credit bureaus to kind of leverage that. And so then Rent has taken all that, they've put it together, and they're trying to solve like, hey, how do I make this experience perfect in this rental space, and for landlords to be able to make leasing decisions. And you see that over and over again. I think that's a really big trend. And so that's where we talk about, the confluence of software and fintech coming together. And it does, well, I mean, it does a number of things. I don't know how much time we have. I can get really geeky here if you want to, but
no, it's fantastic education. Well, I guess in that realm, what you're working on, Pay Theory, is it more like Rent, or is it a competitor to Stripe? I keep hearing Stripe is the next Google, and it will become embedded in everything. It's just sort of foundational to have. No.
So Stripe does some amazing things, right? I mean, like, if I'd still been in Skipjack, I mean, I would have ended up competing against them in many ways, and they kind of flipped the script on its head back in the Skipjack days and in the early internet days. The decision makers were always finance people. They were CFOs, they were controllers. They were the ones who made the decision what was going to be used, and then they told the developers, hey, go integrate this. And Stripe flipped that on its head, right? They focused on the developer, and they solved that part of the problem, thus allowing every startup. And it also helped that payment facilitation came along, because then they became what we call a master merchant, and they were able to create a whole new set of merchants, organizations that never would have been able to get into the payment space before that model came about. But what I hear you, so what they do that exceptionally well. But I think that there are many opportunities. I compete against Stripe, or we compete against Stripe at Pay Theory. But what we do is we have developed a lot of value add specifically around the family tech space. So let's take education, which is our first market that we're attacking, for instance. So what we do that's different from what Stripe does is that we still have the very simple APIs. We have the way to get up and running quickly. We have payment facilitation as a core part of our model. But what we do then is we take and we add a lot of value around that. Okay. And so we do things like we have cash acceptance, something that Stripe doesn't do. So in the education space, 30% of families that are in public educational institutions are or underbanked. And so, it's not possible for those groups to go completely cash free. And so in order to continue to provide access to those groups, that's something that we add to the picture. For the schools, in order to streamline their back office operations, we do things like we have accounting integrations that we've built specifically into our service. We have, what Plaid does, sort of what Plaid does for tying into bank accounts. We do something similar with student information systems that allow schools to take advantage of their rostering platforms and tie that back into the payments, track payments, reconcile payments, get everything over into their accounting package and cut many hours and get rid of a lot of fragmentation in the space. So we see a school district could have for instance, 12 different payment providers in one school district, right? So our goal is to try to unify all that, working with their SaaS, their other SaaS providers that are doing things like providing forms, providing nutritionals, providing messaging services, websites, things like that. So we look to be sort of the infrastructure that ties all those things together to give one unified open experience for parents and users on one end, and on the schools on the other end provide a lot of value add. So there are abilities to take what what Stripe does or what Square does, and really drive it at a specific vertical. Think about what the value is around that, and change the game. So, and the other thing is like, look, if I had thought about all of those things when we started Skipjack, I mean, like, if we had thought about all the people that were already out there doing it, we probably wouldn't have started the company. If we knew how big a daunting task it was, so I mean, like, ignorance, I kind of like I want to lean into the ignorance a little bit, because this is a gigantic space. I mean, like, there are so many opportunities, to do some really amazing things, improve a lot of people's lives, and come up with some really cool tech. That you just don't, if you worry about a Stripe or some big player that's in the space, I mean, I think that there's so many opportunities in and around what everyone else is doing, and you've seen that with banks. I think, like, everybody kind of blew up a banks, disintermediated all these, traditional bank, what we would have considered banking back in the day, and they're pulling it out, and they're separating all these things, and now people are like taking them like Legos and putting them back together in unique ways, right, to solve specific problems. And so now banking happens around an experience, right, as opposed to around, hey, I want to have this experience, but wait a second, I've got to go over to the bank and take care of something, right? So now everything can be reoriented around certain experiences, user experiences, customer experiences, and I think that's the overarching trend that I see in fintech.
Well, as a parent with kids in school, I'm excited to see that happen, because at this point, the integration means all of the links to all of those systems are on one web page.
Right. How many apps do you have on your phone for your kids?
I try to stay away from putting them all on the phone.
Yeah.
You log into it twice a year. It's not a repetitive use.
Right.
But no, that's incredibly helpful. And I guess the bigger those competitors become, the bigger Stripe is, the less some verticals matter to their top or bottom line growth, and that creates opportunities.
Yeah, I mean, I think you see this happening in every industry. So yeah, I mean, my suggestion would be, get out there and go after it. I mean, I'm not a big fan of the old startup, fail fast. I mean, if you're gonna fail fast, but like, we're all here to succeed. So like, let's not fail.
I like that. So as we look to, I mean, we're here to support startups, the ecosystem, and frankly, reduce the failure rate,
right,
and increase the size of success. What kind of things do we think about doing? Should our kind of other partners in the ecosystem think about doing, specifically to help grow fintech companies?
Yeah, John. Well, hey, look, I'm really excited about what you guys have going on with Fintech Frontier, because I think that is really essential to doing that. When I think about a market like Cincinnati that's got a ton of big cos, a ton of talent in these spaces, maybe in certain areas of fintech more than others, but nonetheless, a lot of talent, a lot of insight. Working together, I think, as opposed to, you mentioned the large financial institutions. I think there's definitely a more collaboration that happens in a market like Cincinnati between big cos and startups. And I think that, this bringing together the talent, resources, having the ability to bounce ideas off of each other and collaborate on various opportunities, I think is absolutely essential. I think the thing that we're seeing more and more of, and it's exciting when you do pitch competitions like this, is I think money is one of those key catalysts that we're doing a good job of, but you can never have enough. And so I think attracting more money to non-traditional VC areas is really important, and I think Centrifuge does a great job of shining a light on the startups here in the area. Getting guys like Brad Feld to come and talk at events like this, getting Rise of the Rest, and there's a really growing group of VCs in this area, and so I think that that is I don't want to say it's like Field of Dreams, build it and they will come, but that's the more that the success reinforces success. So getting the word out that there are good startups, good opportunities, that big cos are willing, they're innovating, they're working with startups, they want to attract talent. Getting VCs in that mix as well. I think you've got all the ingredients here, and it's now it's just time to keep grinding away at it.
Terrific. Brad, thank you so much. I just got word. Apparently, we have picked winners.
Oh, awesome. Congratulations to whoever it is. Those were
apparently, we are going to bow out.
Those are great pitches. Nobody wants to hear from us.
To share that. But really, I appreciate your insight and your experience. It's been a pleasure.
Thanks for having me, John. Congrats to the winners. Bye.
Throw it back to them. Let's see.
We actually are back. I want to check audio. All right. Thank you for your patience. Thank you to amazing to hear what's all happening in Cincinnati. So we appreciate you helping us out with that quick discussion. All right. Moment we've all been waiting for. Not an easy choice, and we had some fantastic pitches, all of which are positively impacting their communities, changing the face of financial services, and showing us what the future of fintech should be. But of course, we had to pick just 3. So started, and there's no drum roll, so we unfortunately don't get that. But taking home third prize, which is $15,000, will be We Prosper. Congratulations to Will and the team. Taking home second place and claiming the $20,000 prize is Insure Life. So congratulations to John. And finally, taking home the $25,000 grand prize of the first FinTech Frontier pitch competition. Of the popular vote, as well as the winner of the judge vote, will be Honeycomb. So congratulations to George and his team. Normally you'd have some fantastic applause here, but right now all you get is me. Nevertheless, please join me in congratulating our winners and celebrating all of our finalists who have inspired us so much today. I'll wrap up with just 2 closing comments. First, today marks only the beginning of FinTech Frontier. With the support of Western Southern, Fifth Third, and our future partners, we will continue to expand this effort into a growing list of programs, all built specifically to support, launch, and scale FinTech startups from here in Cincinnati and across this region. I look forward to sharing our 2021 calendar with you soon. And secondly, I want to reinforce the momentum that our entire startup community is building here in Cincinnati. FinTech is an exciting part of that community, but we're also enthused about what we see happening in all of our region's strategic pillars. Those spaces where we have the concentration of technology, talent, and capital to win big versus other regions. We are creating Cincinnati's future and building the kind of tech-based innovation economy that we need to thrive and stay vital for decades to come. Thank you so much for being a critical part of that journey. If you're interested in chatting with any of the finalists, please visit the Expo tab, which you can find on the left side of your screen. A handful will be in person while others will have contact information available. So I encourage you to venture over there, and they'll be there for the next hour or so until we get into the 5 o'clock happy hour. And lastly, I'll leave you with a quick view of into what the FinTech Frontier is and why we're building it here in Cincinnati. Thank you for tuning in, and thank you for all of your support.
A thriving startup community is important for Cincinnati because Cincinnati has always been a driving force for innovation throughout our history. Cincinnati, again, is ripe to be that engine to help drive innovation in this ecosystem. We have great universities, we have great companies to all fuel that energy, and so when that technology comes about and the new innovation comes about, you can feed those directly into the large corporations that touch the world every single day.
Having a thriving startup community in Cincinnati is critical for our long-term economic vitality. As an individual and a working mother who moved here after almost 2 decades in Manhattan, I found myself in Cincinnati. And you might ask why. Well, let me tell you a little bit about this place. First, it's the heartbeat of the nation. When you come to a community like Cincinnati and the greater Cincinnati region, what you find is everyone is willing to help. And it's why I brought my family here. It's why I moved my career here. USA Today ranked us as one of the top places for millennials to live. The second year I moved here from New York City, the New York Times had us in the top 10 list of the 52 places to visit in the year.
We have a half a dozen Fortune 500 companies, and 3 of those are financial services and insurance. You've got companies like Procter & Gamble and Kroger, who are at the epicenter of retailing, branding, and customer understanding. And companies like these, they're going to be your customers, your investors, your mentors.
So customers, talent, and money are the 3 things that a startup needs. And you'll find all of those here in Greater Cincinnati. So in this instance, if you want to talk about fintech, we've got a concentration of insurtech and fintech here, from Western Southern, Cincinnati Financial, Fifth Third Bank, US Bank, PNC. They all have a significant presence here in the Greater Cincinnati region.
A lot of companies these days do lean on startups. And specifically within fintech, there's a big trend for financial services companies to lean heavily on partnerships with fintechs. And a good startup ecosystem of domain expertise, technical expertise, kind of pushing the boundaries into what's new, is ultimately the future wave of how big corporations are going to evolve and invest into new technology and new ecosystems. The corporations that are headquartered here, Fortune 500 kind of focus, they bring a lot of talent into the city and they stay here.
Centrifuge is a startup catalyst that combines services for startups, a syndicated fund of funds of about $115 million in invested capital, and services for big companies that help them think and act like a startup. I'm a California native. In fact, I went to school in the Silicon Valley. I decided to locate my company in Cincinnati because the advantages are absolutely tremendous. Cost of living, supportive ecosystem, access to talent, access to big companies that are hungry to do pilots.
There's no better place to invest in the United States than in the Midwest right now.
We are looking for great startups that want to be part of our community, about building our region, but also about building our business.
So I would recommend any entrepreneur that wants to be able to start a business in a place that isn't going to break your bank and also has a tremendous ecosystem around it and can give you your work-life balance. Cincinnati is definitely the place for you to consider.
Aspiring fin insurtech entrepreneurs in Cincinnati will welcome you with open arms, and we'll do everything we can to help you ramp up really, really fast.